So once again, I would like to welcome all of you to this session this evening. There are a few things that I'm hoping that we could resolve because, as you know, inheritance tax is a voluntary tax. And the purpose of tonight's meeting is to enable you to appreciate that it's not a tax that you've got to pay. We pay taxes all our life, we pay income tax, but inheritance tax is one that if you understand how it works, if you understand the process of inheritance tax, how to evaluate it, then there is no reason why you should have to pay inheritance tax. Now, this session is mainly for persons who are from the UK, but if there are any other persons from other countries who are here tonight, you are welcome. And it would be nice if you could just state in the chat which countries you are from, because I know that in the Caribbean, for example, in St. Lucia, there is no inheritance tax that has been abolished. But in the UK, inheritance tax stands at 40%. I would like to welcome you, however, and wish you the very best. And I'm sure there's always something that you can learn from what we are doing here this evening, because this is not only going to be about inheritance tax, but how you can write a tax efficient will, because the objective of understanding the inheritance tax provisions is that you will be able to write a tax efficient will. Let me introduce myself. I am Deborah Bowers. I am a STEP certified advanced will writer. I'm also a data protection consultant or specialist. I've qualified in the CIPPE and the CIPM, and I'm also a solicitor of England and Wales. I am also the author of How to Write a Tax Efficient Will. You can see it here, this is the second edition of my book. The first edition was a bestseller on Amazon, and so the book is still a bestseller. It has been received very well, and it has so much in there to help people save money and to also help them write their own will. But when writing your will, to understand the inheritance tax provisions. So I have literally broken it down for persons who are single, persons who are married, persons who are in merged families, because merged families are very common these days. This is where one relationship has broken down and you have met someone who has kids, you have kids, and you've come to live together. So it's all catered for in this book, How to Write a Tax Efficient Will. Some of the main differences with this edition is that it also addresses lasting powers of attorney. I found that having written the first edition of the book, which was only focused on will writing and in the inheritance tax provisions, lots of people actually wanted to know about lasting powers of attorney because they were looking after elderly relatives or they themselves were getting a bit older, and just to protect themselves should anything happen to them, so that someone has authority or permission to do things on their behalf. So in this second edition, I have gone to the extent of writing all about lasting powers of attorney, showing how it works in principle, putting the forms in there for you so you can't get it wrong. You will know exactly what to do should you require one. I have to give you a disclaimer here because you can't take anything I say here as financial advice or legal advice. I am a solicitor of England and Wales, but the writing of wills is not regulated by the Law Society. Neither is this investment advice. So before you do anything to your detriment, please get your independent advice. But I'm giving you the information that I know to the best of my knowledge and understanding. And as far as I'm aware, the information which I'm providing is up to date as of today. Now, why would you need or consider a tax efficient will? There are a number of reasons why we would want to have a tax efficient will. Some of these reasons are your beneficiaries. Your beneficiaries are going to have so much more. 40% of your assets is quite a lot. Imagine that you had £100,000 over the threshold and the government is taking 40,000 of that out of your pot. So £40,000 is a lot of money for anyone who could get that benefit. So this means that you will leave so much more for your beneficiaries. And I think everyone wants to achieve that because it's really a voluntary tax. It's who knows and who knows benefits. And my role here is to help you understand it so that you could be one of those that can benefit from it. Sometimes people say to me, one of the things they say is this legal? That's one of the first things they say. And I'm like, if it was illegal, they would have arrested me by now, you know? So none of the information that I'm giving you here is illegal. It's a 40% tax. It has rules which call as to how it is applied. And so if you know how to apply the rules, then you are able to work with the tax and save it. That's what the purpose of today is. So also, as I say, it's a voluntary tax. You're also saying enough is enough. In life, you are only certain of two things: death and taxes. And by the inheritance tax provisions, if you are able to save it, you are just saying to the taxman, look, enough is enough. You've taken as much as you can from my lifetime. Right now, I have had enough. I'm gone out of this world, no more. So I describe it as your way of rowing back at the taxman and saying, look, I've had enough. Enough is enough. Another thing which I have found so distressing is that sometimes the beneficiaries literally have to sell the asset that you've left them so that they can pay the tax. And that to me is very hurtful because you left your kids with something, you've left your beneficiaries with something, and because they can't afford to pay this tax, they've literally got to sell the assets and so that the tax can be paid. Right, put a thumbs up in the chat, or do you agree that that's a bit distressing, where your beneficiaries will have to sell the assets to actually pay the tax and they're left with nothing? Whatever you had given, whatever you hoped they would get, they don't receive a thing. So these are some of the reasons why we want to arrive at a tax efficient will. Now, you may not be able to see all of this presentation here, but it explains to you, and I will go through it to explain to you what happens to your assets if you don't have a tax efficient will, or if you don't have a will, period. Okay, if you don't have a will, have any of you in the chat got a will? You all have a will? Do you have a will? Let's see, do you need a will? Well, I just want to let you know what is likely to happen if you don't have a will. If you don't have a will in the United Kingdom, in the first case scenario that I'll put forward to you is that you are married with children. And if you are married with children, the government will then also divide your assets the way they see fit. And if you are married with children in England and Wales, £250,000 of your asset goes to your spouse or your partner. Now, it's not the person you've just been living with for the last 20 years. No, it doesn't work like that. It must be a marriage or a civil partnership. If you're not in either of those, you will have to make an application to the court under separate provisions so that you can get a share of that estate, or you can be considered to be a common law relationship. But we're talking about civil partnerships or marriage. All your personal belongings will also go to your spouse, and 50% will be held on a statutory trust. The government will say that is yours. and the other 50% is going to go to your children. So that when you pass, whatever was left of that 50% will then pass to the children. So here again, if you don't write a will, you leave it up to the government to decide how to divide your assets. And that's distressing as it is. If you are married but you don't have children, then the government will give £450,000 and your personal belongings to your spouse, plus 50% of whatever is left after. The remainder goes to your parents if they are still alive, your siblings, your brothers and sisters who never spoke to you all your life, or your nieces and nephews, if you have any. So once again, things will not go the way you would like them to go. They're just going to go as the way the government sees fit. If you have children, but you have no spouse, then your assets will be divided equally between your children. And sometimes some of your children have had nothing to do with you throughout their lifetime once they became adults. But your assets will be divided equally amongst them. And of course, they will accept the gift. No one is likely to say, I don't want it. The fourth scenario is that you have no spouse and you have no children. In that case, your assets will be given to your parents if they are still alive, your siblings, or their children, your nieces and nephews. If you have none of those and you have grandparents, then it will start going backwards, uncles, aunts, and the rest. And if you were to pass and there is nobody, the last one to give it to, guess who gets it? Come on, put a guess. Guess who gets it at number 5? Guess who gets it? We have a big clue here. Who gets it? King Charles III. Okay, it's King Charles III is going to get your estate. That's right, the government. King Charles III. It goes to what is called the crown or the state. And so I don't know how you would feel about that, but that's who will be receiving your assets if you don't sort this out. So we don't like any of those scenarios. So this is why we need to focus and mind our business, pay attention to what we are doing in our lifetime so that we can have tax efficient wills and save inheritance tax. Now, the inheritance tax provisions, what are they exactly? As I said, 40% of your assets is taken by the Crown, but that's where your assets exceed £325,000. Now, how many of you know of a house in London that's worth £325,000? It's hard to find a property in London that's worth £325,000. So any value above that amount, 40% is going to go to the government unless an exemption applies. And this is where you need to understand what your position is and what the exemptions are, because the exemptions all depend on your circumstances, your personal circumstances. So we can go through to see what this would look like for different people in different circumstances. Just as we looked at previously, what happens to your assets when you are married with children, not married, no spouse, no children. We need to do the same calculation based on your personal circumstances. And all these various circumstances are covered in the book, How to Write a Tax Efficient Will. Now, we start this journey here by firstly understanding what is called your net worth. Now, Rose, I know you're on there and you're an accountant. I know you will know what your net worth is. But many people don't understand all the things that they need to take into account as to what makes up your net worth. So we will look at things like your assets, your house, your car, Other digital currency, now the world has gone very digital. If you have any copyright, if you have cryptocurrency, if you have cash, if you have a pension, if you have shares, you know, and all these things are going to be part of your assets. But to understand your net worth, you need to subtract from those assets any liabilities that you have as well. So that's how you arrive at your net worth. So as you can see here, minus your liabilities. But don't forget all the different things that you've got that will be forming part of your assets. So let's see what we arrive at here. So you will deduct from all your assets, your mortgage, your personal loan, your credit cards, your unpaid utility bills, your unpaid taxes. So your gas, your electric, those things that you have not paid at the moment of your passing, all these things need to be subtracted from your net worth. So the figure we get thereafter is called your net worth. And if your net worth is above £325,000, then you run the risk of paying this 40% tax. So the 40% tax is only applied after you have passed the £325,000 threshold, which was your net worth, your assets minus your liabilities. If it is beyond £325,000, then you run the risk of paying that 40% tax. Now let's see what we can do about it. So we lose our assets as we grow older and throughout our lives through taxes, which we pay. We also lose our assets through the cost of care. And we lose our assets also when we lose money on the stock exchange. You know, some people do lose their assets, or their assets, their little pot that they were hoping to secure for their future on the stock exchange. So that's how we lose our assets during our lifetime. So now we will look at some of the exceptions or exemptions that apply as we go through the rest of the slides. So we have established that the inheritance tax provisions start to bite after you have passed the £325,000 threshold. And one of the exemptions which a lot of people might be able to benefit from is the fact that if you have a house, so here is a person with a house, and they want to pass this house to a direct descendant of theirs, a child or an adopted child of theirs, then there is an allowance of £175,000. So for example, if you have a property and it's valued at 300,000, it has a mortgage of 100,000. So the equity in that property is only 200,000. You will only be able to benefit £175,000 to pass on to your children. That's the value you will be able to pass on to your kids. So for a single person with a house and a child that they want to pass on to the child, the benefit that they will have is £325,000 plus the £175,000, which makes it £500,000. And anything above that, the 40% tax applies, it bites. So they'll pay 40% tax of anything beyond that. Of course, unless they are able to claim some other exemptions. So that's why it's important to know what the exemptions are and what you can claim. So if you just have a single person with no house, how much do you think the person will be able to achieve out of this? What will be their threshold? Anyone knows in the chat? They have no house They have no, whether or not they have kids or not, but they have no house. Just a single person with no home. How much do you think the threshold would be for them? Anyone is following enough to know what the answer is? It's right staring in front of you. They've got no home. Their threshold will be £325,000 only. Okay, because they've got no home, they've got no child to pass it on to either. So their threshold is 325,000. If they've got a home, a dwelling, it must be a place where they're living. If they've got that, they've got a child to pass it on to, their threshold is $500,000, and that's what their threshold is, unless another exemption applies to beef up what they can pass on to their kids. So some of the exemptions that we need to be clever about are the transfers between spouses. Now, I know these days the world is what it is, and many people can't even trust their left arm from the right arm. But if you have a spouse that you can trust, transfers between spouses are 0%. So you can pass 10 billion to your spouse if you know that your spouse is going to do the right thing. So that's when people write mirror wills. I trust my spouse. I believe he will do the right thing. He loves me. He loves the kids. We want to benefit each other. We transfer the property between each other so that whoever passes first, there is 0% inheritance tax. And the second to pass will then deal with whatever needs to be passed on. And they will do it in a way that will benefit. And both of you make the same will, saying the same thing. And that is called a mirror will. So if we know about transfers between spouses, we can take advantage of that and so pay 0% on the first to pass. Transfers to children, if you are spouses and you have a house and you have children, a place where you live, you reside, you will find that both spouses are entitled to the 325,000 plus the 175,000. So that's $500,000 on this side, $500,000 on that side. And because of that, you can pass a maximum of 1 million to the kids without paying any tax. Isn't that wonderful? 1 million isn't enough if you are mega rich, but for people who are on the margins, 1 million is good. It is good to know that, you can pass up to £1 million to your kids tax-free. So, yeah, so you could do that if you are aware of those exemptions. If you're not aware, then you will find yourself writing a will that does not take that into account, does not try to save you from that. And I will tell you later just how people write wills which prevent them from getting that advantage. So in this case, we see that how a husband and wife with a house and kids can protect their children and pass on that £1 million of value tax-free, and the taxman gets 0. Okay, so another way you can also benefit your family is by having a business. And a business does not need to be a company. It could be a sole trader business. It could be agricultural property, because you can claim business property relief and agricultural property relief. Now, the way you claim those reliefs is that you can claim agricultural or business property relief to 100%, 100%. And you just have to comply with the rules that are applicable to making that claim. So it must be a business that was set up for making money, for making profit. It could be shares in an unlisted company, and you can claim 100%. People are always advised to claim the 100% and let the taxman wrangle with you if he wants to reduce it. So you claim 100%, but it can be a sole trader, it can be a company, it can be a partnership. So There are some rules to be applied. You can only get the relief if you owned the business for at least 2 years before the person passed. And having the business at least 2 years before the person passed means that you could even claim that provision in your own lifetime. You can pass the business 2 years before, so that you can claim that relief. You can pass the business 2 years before you pass in your lifetime, or you could have had the business 2 years before you passed. So either way, whether you pass the business on in your lifetime or you pass the business at the point of your passing, you still can claim that relief. So, but you can't claim the relief if your assets are mainly, you just buy a company that just buys land. So you can't claim it if you mainly deals in securities, in stocks, or things like that, or if it's a non-profit organization. You cannot claim business property relief or agricultural property relief. And when you're claiming those reliefs, any assets of the business also gets the relief, because if those assets are being used in the business for the purposes of the business. Okay, so you claim the 100% and let the taxman wrangle with you to see if he wants to reduce it. Another exemption that you can also benefit from is charities. Sometimes you hear the absurd thing of people leaving their properties to certain charities, the Dogs Trust, the Cats and Dogs Home. To us, it might be absurd, but you get 100% relief. If you transfer property to a charity, you even get, if you're up to about, I think it's about 20% of your estate, it's tax-free. It reduces, it gives you an allowance. It reduces the amount of tax you would have to pay. Can you imagine that? So charities are organizations which benefit tremendously. So if you make a transfer to a charity, the charity does not have to pay any taxes on that. And you can also get a deduction in your taxes if you have to pay any, because you have made a contribution to a charity. Also, gifts to political parties. Well, some people you can't joke with them and their politics. So if you make gifts to political parties, that is also something that you reduce your taxes by. So you can reduce the value of your estate by making gifts to political parties. And there's a different thing for different people. So you can also support the organization or the political party that you wish to benefit or you wish to win the next election. So let's see how in our ordinary lives, the people who are not, they're not at the super rich, although I do deal with the super rich a little later. Those who are in their ordinary lives, they have the basic things. You have a pension pot. This is your pie. You have death in service, and you have insurance. These are things that people normally have. Ordinary people like ourselves hide that's part of the pie. Now, if you wish to make an adjustment to ensure that you escape that 40%, these are some of the places where you can make that adjustment. In your pension pot, in your insurance, and with your death in service benefits. For example, your pension pot, it is best to write your pension pot in trust. And all that means really is that you nominate someone to receive it. Just nominate someone to receive the pension pot. And if you do that, it does not go into your estate. Remember, your estate must be over a certain amount. So if you're a single person, you have no house, you have no child to give it to, and your allowance is just £325,000, and you have a pension pot that's worth about 200,000. By the time you've added that to whatever you've got, it might take you above the threshold of £325,000. So when you write in your will, if you put all that in there, you'll pay an unnecessary tax, Because what you could have done was remove the pension, pass the pension to someone else or to 2 or 3 people, and you write it into trust so that those people will benefit when you've passed, and it will not fall within your will. And when you've done that, you've reduced the value of your estate. So if you only had 100,000 in the bank, or anything under 325,000 pounds in the bank, then you are paying zero. But if you had put the pension pot in there as well, then you increase the value of your estate. And so you've got to pay an unnecessary 40% on what's over. And I've seen some horrible wills, and I'm like, are you serious? Who wrote this for you? Because they could have avoided, they're having you pay inheritance tax for nothing. Because as I always say to people, my motto is, anyone can write a will, but not everyone can write a tax efficient will. So that's what I do. I specialize in making sure people write tax efficient wills. The second thing you can do is also your death in service. Some of us have great jobs. They give you a death in service benefit if you pass on the job. Of course, if you leave the job, you no longer have that benefit. But what you need to do is put that into trust as well. Nominate people. Don't delay. Nominate people that you want to benefit. You can nominate more than one person. And do the same thing with your life insurance. Okay, so you move that asset, you take it out of your estate. So you're reducing the value that's in your pot, in your pie, for your benefit, and you're not leaving it in the pie for the taxman's benefit. So these are some of the things you can do to save yourself this inheritance tax provision of 40%. So what would be the benefit to you of applying all these strategies once you understand them when writing your will? So you get to keep a bigger portion of your pie. You know, the taxman is like someone who just takes from you. Before you get your salary, he's already taken his bit, you know, every month. And he does that throughout your lifetime. Okay, you also leave more for your loved ones who you have left behind, who have taken their time to care for you and everything. And the little that's left, the taxman still has to get his share, you know. And it also allows you to sleep easy, knowing that your family will not need to sell the asset. You know, that is so painful. Your family will not have to sell the asset. They're already making you sell your assets when they have to take care of you for care purposes. And the last little bit your family has left, they will not have to sell it in order to pay the inheritance tax. So they're still left with zero. So these are some of the benefits of you writing a tax efficient will. So how do we achieve this tax efficient will? As I said previously, we get there by understanding the exemptions, understanding what the benefits are, what the threshold is, and then applying it to your life if you are single. If you are single with kids, what will be your allowances? What will be your exemptions? If you are single with a house, if you are single with a business, because it all depends. If you are married with kids, if you are married with kids and a business, or if you've got a merged family. So it all depends on the circumstances of each person. But what is most important is that we know and understand what our allowances are and what the exemptions are, and how we can use the allowance plus the exemptions to save that tax. So I will invite you all to, well, subscribe to, you can order the How to Write a Tax Efficient Will book, which is available on Amazon right now. It's only $14.99. You can also subscribe to my YouTube channel. There's just so much free information there, you know, to help you along. And you have the audio of my book, the various chapters, the first edition of How to Write a Tax Efficient Will. You can also write to me. You can email me. It's Deborah Bowers Will Writing @gmail.com. If you want any further advice or assistance, or you can call me. It's 079-818-10322. So if you need help, if you need my assistance with writing your will, please feel free to reach out, and I will take into account your circumstances, and we will get that will in place for you. If you also need a lasting power of attorney, let me know about it, and I will come to arrange that for you, because you need someone who is called a certificate provider, and you need someone to assure the Office of the Public Guardian that you were sane when you appointed those people, you knew what you were doing, because I found that a lot of people leave it so late. They leave it too late. When the person has had a stroke, they cannot sign, they're not strong enough, and it takes a lot to wait for them to just be able to make a mark on the paper. And it's very hurtful to me, it's very painful when you know that somebody was once strong and they were in charge of their lives, and now they're struggling, but some families just leave it too late. So it's good for us to put these things in place so that if anything happens to us, there will be someone there who can go to the bank for us, probably sell an asset for us, take an action for us, make decisions in relation to our health care or our financial decisions. So I hope you've enjoyed the presentation tonight. I'm opening the floor for questions. If you have any, you can unmute yourself and ask me any questions you wish to ask, and I will be more than happy to assist you, or you can put your questions in the chat. Any questions?
Hi, Deborah. I just want to know, you mentioned a merged family, and excuse my ignorance, please explain.
Oh, yes, merged families. Merged families are those where your original family has broken down. For example, you have a man who marries a woman who has a child. They both come in with assets. The man might have some assets, the woman might have some assets, and they've come to live together. Now, in these types of families, everybody's watching everybody. They don't want the other side to get what their father brought in or it belonged to them, unless they have resolved it in some shape or form, amongst themselves. So when you live in a merged family where the man marries a woman with children, the man had his own children, that's what is called a merged family, and you made it one family. You need advice to decide how best to divide the assets so that all parts of the family win. It's a win-win for everybody, and this is what is called a merged family.
Thank you.
You're welcome. Thank you for joining, Marcy. I really appreciate you being here.
I thoroughly enjoyed it. It was my pleasure.
Thank you, Marcia. Yes, I think Janet had her hand up.
Yes, Deborah. Hi. Can
Hello.
you just talk a little bit more about putting your assets in trust?
Oh, yes. Putting your assets in trust. Now, one of the things that we need to also investigate is, apart from putting things like your pension and your insurance into a trust or writing it into trust by nominating people, another option for the mega rich, for the super rich, you have 2, 3, 5 properties or more, or you are worth millions, or you will not escape the tax. What you can do is set up a trust. It could be a living trust where you put all your assets into the trust from the time that you are alive. You appoint yourself and others, or yourself along with other options, other people as persons who will be managing the trust, and it's a discretionary trust. And the beneficiaries under the trust will be discretionary beneficiaries. For example, I have a 10 million estate. I decide, you know what? If I give those assets to the kids, I really don't know what they're going to do. People might try to get into their lives so that they can get the assets of them, because we know how people are these days. The best word for them is avaricious. They want to reap where they did not sow and take what doesn't belong to them. they want to benefit off another person's back. Sometimes people are like that. Or they get into a relationship with you only to benefit from what you have. So if you don't want your kids to fall foul to such people, you put your assets in a trust, and you can do that at the point of your passing, or you can do that in your lifetime. You can do it in advance. Now, the way the trust works is that you put the assets into the trust from the time that you are alive, and you set it up, and there is a fee for putting the assets into the trust, and there is also a fee for taking assets out of the trust. I think it's a 4.25% of the value. And when you take assets out of the trust, it's the same, that 20% of 4.25. I will get the information for you, Janet. What you then do is that every 10 years, the trust has to pay at 20% in tax every 10 years, but it does not pay the tax before that time. So the benefit of that is you're not paying 40% tax, but you do pay some tax along the way every 10 years. So you can either set up the trust that you put all your assets into this relevant property trust before or at the point of your passing in your will. And then you have appointed your trustees to oversee that trust. It's a discretionary trust for your kids, and the children do not actually own the assets. Their needs are being determined or assessed by the trustees. And if the trustee thinks, okay, yes, you say you need 2 pairs of shoes and school fees, okay, we'll pay it. But any partner that they have or they get will not be able to get anything from that trust, from the child. So if the child goes and becomes a gambler, the gambling debts cannot be claimed on the trust because the assets don't belong to the trust. If the child becomes a druggie, then that's tough. It's your problem. We can pay rehab for you, but you will not be getting any money into your hands, or you'll get such a small amount. So the trustees decide how they're going to assist that child, but the asset does not belong to the child. If the child gets married to a rogue, the rogue cannot get anything when the divorce happens because the assets don't belong to the child. So it is one way of really protecting your family. If your assets are so far up above the threshold, you cannot get out of it any other way. The best thing to do is to put all your assets into a trust. You can still probably give the children something from an insurance or a share or something, but the main assets that you want to protect, put it into this living trust and protect it that way. You will manage it until you're passing, and you can also nominate people to after you, who is going to be appointed, the trustees after you, to manage that trust. I hope that helps, Janet. And that was a very good question.
It does. And can I ask another question? It does. Thank you, Deborah. It does. Yes. Can I ask another question?
Sure. Yes.
Okay. So with the tax efficient will, yes?
Yes.
Is the format of that will different from like a normal will? Because, you know, like we've got a will, which we've done it through will writing services.
Yes.
Many moons ago.
Yes.
So with the tax efficient will, will you then need to tweak it, or is there a different format that you would use to do that?
No, the format is not different. What is different with the tax efficient will is that I take you through, I go through what you've got, and I said, look here, this will is going to cause you to pay 40% tax out about this amount, because we have arrived at this threshold here, and anything above that is 40% that goes to the taxman. You can rearrange your assets so that you do not pay that to the taxman. And what I have found as well is that a lot of the wills are written with the step provisions first edition. because they were written about 10, 20 years ago, and there's the first edition of the step provisions. And people are asking me now to revise their will to put it up to date with the second provisions of the step standard provisions. So their wills were written when there were things like the rules of perpetuity and those things still in place, and those things have changed. So now they need to just get an updated will.
Okay.
Yeah.
Yes. Thanks for that. It makes sense.
No problem. You're welcome. Each one of you. I'm so delighted. Some of my favorite people are on tonight. All my favorite people are on tonight. And I'm glad that I could have assisted you with some valuable information. Any other questions from anyone?
Deborah, I had my hand up.
Oh, yes, Rose. Yes,
Okay.
Go ahead.
Just a quick question in regards to the business. You said about having your asset attached to the business.
Yes, business property relief. No, business property relief. If you have a business, you can claim 100% business property relief.
Okay.
And you can see all what you need to, what the rules are by going to gov.uk. How do you claim business property relief? And you can see it must be a business that's set up to make money. It's for profits. It can't be a charity. So if all the rules are there, I can read out some of the rules for you. I have some of the rules here, for example, and you can claim either 100% or you can claim 50%, but it's always best to claim the 100%. Well, claim 100%. And if the taxman wants to wrangle with you, let him wrangle and tell you he'll only give you 50%. Okay. But you try to ensure that your business fits within the rules. What qualifies for business property relief? And on the government website, where you'll find much more information, it says you can get 100% business property relief on a business or an interest in a business. So you don't have to own the whole business. You just need to have a business or an interest in a business and shares in an unlisted company. Right. Okay. So it has to be a limited company then. If you're self-employed. No. Okay. It can be, as they said here, a business or an interest in a business. Shares in an unlisted company, just another option. Okay. Yeah. Okay. So it doesn't have to be, and you can go on the government website to verify that. How can you claim, or what qualifies for business property relief? It doesn't have to be a company. It doesn't have to be it can be a sole trader or a partnership. What I tell people with a partnership is have a partnership agreement. That proves that you have a partnership. Right. Yeah. So if you if you're a sole trader, you can also claim business property relief for the assets that were being used in the business and for that business. Yep. Okay. All right. And can I ask one more question? Of course. You've got the floor. In regards to LPAs, do you recommend that you get one or two or a combination? What would be the recommendation? I know it might be in the book because I'm going to get the book. Well, for lasting powers of attorney, it's divided into two. Right. There are lasting powers of attorney which relate to your financial decisions, and there are lasting powers of attorney which relate to your health and care decisions. So as we look after older people, we find that sometimes they are not able to make the financial decisions that they need to make in relation to their circumstances. They might have to sell a home to pay for their care, or they may have to do other things so that they can be looked after, or just to release some money or to pay for something, and they can no longer take that trip to the bank. One of the things that you must understand, the power always remains with that person. It doesn't shift. You having the lasting power of attorney on behalf of that person needs to make the decisions in the best interest of that person. And you must also do what the person asks you to do. It must be, you must be helping them to make the best decision,
Mhm.
but you still need to follow their instructions.
Okay.
So you cannot take the power of attorney and go and do your own thing. You'll be in breach of the law. The powers of attorney are registered with the Office of the Public Guardian.
Mhm.
So you'll be putting yourself at risk if you do what is not required of you for the benefit of that person. So it's in two parts, financial decisions, because sometimes you need to deal with a person's finances.
Mhm.
And the other part of it is health and care decisions.
Right.
So when the person is in hospital, you can make decisions as to turn off the life support or not, because they may have told you, feed or not to feed, or should they have that operation or not have that operation, because they have discussed these things with you prior to their illness, or you try to make the best decision for them, having spoken with the doctors, and they can no longer respond to make the decision for themselves. So you need that power of attorney to make those decisions for their care.
Is it advisable to have one person with these two responsibilities, or better to have two people?
The thing is, there are people you can always notify. The persons to notify are the persons who, if they feel something is wrong, they can contact the Office of the Public Guardian. And with everything in this life, it's all about trust. It's all about the quality of the person. It's all about how well you've known that person. But people can change. I see you have 50,000 in the bank, and so I decide, what I could do with that. These are things that we have to face in our ordinary life as human beings. So it's all about the quality of the person that you are appointing. If you are convinced genuinely that this person will do what is in your best interest at a point in your life when you are most vulnerable. I cannot, if I had a magic wand, I would be able to tell you if the person is trustworthy or not. I wish I could.
Yeah.
But you have to use your best judgment.
Yeah. I wasn't thinking really on the trusting. Well, even though that comes into it, I was just thinking because it's two separate things. Whether
but one person can do it. One person, like I only have one child. I mean, I would allow my child, give her both to do the care decisions as well as the financial decisions. There's nobody else, as far as I'm concerned. Unless my relationship with my child breaks down so terribly that I give it to another person or two different people. So it all depends on the circumstances.
All right. Good. Understood. Thank you so much.
Yes. You're welcome.
Thank you.
Any other questions? I see we were joined by someone very late, but you're welcome to join in. We've had a very lively discussion. If you have any questions about inheritance tax or any of the issues that we have raised here tonight, we have discussed, please feel free, subscribe to my YouTube channel, encourage your friends and family to subscribe, because there is a lot of information there that's all free about inheritance tax and about dying without a will. If you wish to contact me, you can contact me at deborahbowerswillwriting@gmail.com. You can also call me and 079-818-10322. I will also be discussing various aspects of the book, How to Write a Tax Efficient Will. All the information that I have discussed here tonight with you is available in the book. I have also created a course, How to Write a Tax Efficient Will course, where I discuss every little aspect with you and take you through. And at the end of the course, as well as the end of you reading the book, you will see that you can write your own will, because I literally write out wills for people in the book. So it gives you examples of the wills. It also provides you with the step standard provisions, the second edition, so you can see what powers you can choose to apply to your trustees, or you can actually just say in short form, the step standard provision second edition will apply. So immediately your trustees have those powers, or you can pick and choose what powers you want them to have. Okay, so it's all up to you. I would say if you want to save big, buy the book because it is only $14.99, and writing a will cost you a minimum of $250 or £500. It all depends on the company you are going to use.
Let me ask Deborah this. Deborah, can I just say something? Yes?
Yes.
Okay, so we've got a will, and I say with Youngs, and it's young many years with writing service, and from time to time, okay, so we kind of update the will, which
Yes.
obviously what they do each time you do that, they just send a copy, and then you tweak it, send it back, then they update it, and it's kept in their whatever vault they say.
Yes.
So if what I need really is just to tweak this will here
Yes.
into a tax efficient will,
Yeah.
is that something that we can do? Because I mean, like,
yes, you can do that because it's just a review of your will.
yes,
They can look at it and say to you, look here, you've got all these assets that's going in, that's being managed under your will. You can take these out and deal with them by this way. You can deal with them this way so that you benefit the people that you love, and the value of your estate is shrunk. Or you can set up a trust instead to deal with your assets differently. But I don't know how they operate. You'll have to speak with them and see if they would like to charge you more because the change is big. Or sometimes some of the people that you had nominated as your trustees or have passed, and you want to change those people.
Yes, what happens is, I mean, if whenever any little changes, I'll ring them and I'll say they don't charge me, and I'll say I need just to make some changes.
Yes.
And then I just put all the changes in.
Yes.
Then they update it and send it. But I don't know, like, well, it's tax efficient. I don't know if that will mean anything different to them, and they may need to charge a little bit for that. But they're normally quite good. I mean, you just update, send to them, sort of thing, and they just update it and they send you a copy. Yes. Well, you've got to get it signed off as well. Like, when you share an update, you have to have two people witness that, sort of that, that's correct. If that's what
that is correct. That is correct. Even though it's an update, you've got to get it properly signed.
It has to be signed properly, and then
the thing is, some companies offer a very good service where you can make a certain amount of changes without any further charges.
Yes.
But not all companies take their time to explain to you about how to get the will to be tax efficient. Okay, and that's where I make the difference, because anyone can write a will. Anyone can write a will. I've written lots of will options in the book, and you can just literally write a copy of that and just get your two witnesses and sign in front of them, and you've got a valid will. But it's whether or not they take their time to go through the inheritance tax provisions so that whether or not your will is tax efficient and whether or not that was the best options for you when you wrote your will. So I specialize in that aspect of it.
Okay. Another thing, Deborah, your book, has it got like standard forms in it, or it just points you to get a form?
It has the standard forms for the lasting powers of attorney. It has the form for both the financial decisions and for the health and care decisions. Okay. And those are forms that you can also get online.
Yeah, online.
Yes, but I actually printed the form so people can see everything for themselves in the book. The book also has all the step standard provisions from the top to bottom. So as I said, you can choose. And it also does, what it does is it gives you a section on assets and liabilities where you can check what are your assets, what are your liabilities, and get your net worth.
Yes.
And because you need to know your net worth to know whether or not you'll fall foul of the tax. It sets out all the exemptions as quite a few exemptions. There might not be all the exemptions in the world, because I am not a financial advisor, so to speak, But I set out as many exemptions as I am aware of which I know that lots of ordinary people might fall within that bracket, and what they can do about it. So you will be able to calculate your net worth. You will then be able to see what the exemptions are, and you'll be able to apply those exemptions to you and determine, okay, what could I have done? When you look at your will that you've got, to make this will more tax efficient, so that I reduce the value of the estate, so that the value, in your circumstances, I know you personally, I know you can pass $1 million. So are there things that you can remove out of your estate? You can move, no, I'm not saying, I'm saying that's what your allowance would be. I'm not saying that's your worth. I'm saying that's what your allowance would be, because I know you are married, you have kids, you have a home. So what you would be able to pass on tax-free is $1 million, right? So now I would look at your will and say, okay, but what is in your will that you could have passed outside the will to reduce the value? So it is less than $1 million, or it's a maximum $1 million. And there isn't that 40% that the tax man can take after the $1 million.
Indeed.
Or whatever is left after the $1 million. You understand?
I
So
get it.
this
I
is
get
what makes it tax efficient.
I get it. Yeah. Thanks, Deborah. Yeah.
You're welcome. I see we've joined by a new person. Welcome, you're at the end, but you're still welcome to How to Write a Tax Efficient Will. Hopefully, I have explained how we arrive at a tax efficient will, and that everything that I've spoken of is in the book, How to Write a Tax Efficient Will, as well as lasting powers of attorney for financial decisions and for health and care decisions. So if you're interested in all the information to do with writing a tax efficient will, as well as health and care decisions, then you can get the book, and it will explain everything to you. You can also contact me. All my details are here. How to Write a Tax Efficient Will is written by me. I have got a YouTube channel as well, which gives lots of free information. I read through the first edition of my book, How to Write a Tax Efficient Will. For all the persons who have attended today, please contact me. I intend to give you a free copy of the first edition. I appreciate the fact that you've taken time to spend time with me today, because it gives you all the inheritance tax provisions, it tells you how to apply them, and it also has lots of will samples in there and gives you the step provisions, and also it gives you your assets and liabilities check, so that you can see whether or not you wish to write your own will or wish to contact me to help you along. Okay.
Can I just ask one more question, Deborah?
Yes, Rose?
Your YouTube handle, is it just your name?
Yes, it's Deborah Bowers channel. It's not, there's no excitement. Deborah Bowers channel. You can subscribe.
I'm thinking, oh, all right, let me just ask for clarification. Okay, thank you.
That's right. I have about 115 subscribers, so please subscribe to the right one.
That's all right. Yes.
I'm wearing the same dress. It's Deborah Bowers channel, yes.
Okay, thank you so much.
You're welcome. Any other questions? Yes, I see someone has placed something in the chat. Well, I'm glad you've all found it very informative. I'd like to thank you for taking the time to join me here tonight. I know you have taken time from your busy schedules to be with me, and I'd just like to thank you so much. I'm glad that you found it very informative. Remember, you can contact me at deborahbowerswillwriting@gmail.com. You can also call me, and you can also subscribe to my channel. I've also got a course. Thank you, Janet. Thank you. And I'm so pleased that you have found it very useful. So contact those people that are writing your will for you and see how they can help you make it more tax efficient. Yes? Okay, well, I'll say good night. And I hope you all have a wonderful evening. And subscribe to my channel. If you can't afford to buy the book, at least subscribe to the channel, because there's so much information there. And I will also be putting this video on the channel. so that you can go back to it and refer to it in your own time. Yes, if there's anything, any information that you found useful or you really want to recall, as the video is being recorded, it will also be available on my YouTube channel. So have a good night and thank you so much for attending. I shall stop the recording right now and we can chat later. Good night.
Good night, everyone. Good night, Deborah. Thank you.
Bye-bye.